Welcome to This Explainer. Today, we're tackling a topic that literally gives business owners and accountants alike major headaches: the multi-state tax maze. If you do business in the United States, you aren't just dealing with one tax code. You're navigating over 7,500 different tax jurisdictions. Between counties, cities, school districts, and the states themselves, the sheer complexity is staggering. But don't worry, we're going to break it all down and demystify exactly how state and local taxes work.
Let me ask you something to kick things off. Have you ever wondered why you sometimes pay sales tax when you buy something online and sometimes you just don't? It feels totally random, right? You buy a book from one website and get hit with a 7% tax, but then you buy a t-shirt from another and it's completely tax-free. Well, it's actually not random at all. It all comes down to a set of very specific, very fascinating rules that govern out-of-state taxation.
Okay, let's make these abstract concepts a bit more real. Meet our case study for today, Ken Brody. Ken is the sole owner of Wild West River Runners, which is a C corporation based out of Idaho. They do guided whitewater rafting adventures, but they also sell merchandise locally, and they have an internet-based retail store. Looking at Ken's setup, you can see how fast things get complicated. He doesn't just stay in Idaho, right? He sells goods in Arizona, California, and Colorado over the internet. He has physical stores in Idaho and Wyoming. He provides rafting services in Tennessee and Washington. For every single one of these states, Ken has to figure out, does he owe sales tax? Does he owe income tax? This is the multi-state tax maze he has to navigate, and it's the exact same maze we're going to solve today.
Here's our roadmap for today. First, the multi-state tax maze. Second, sales and use taxes. Third, income tax nexus. Fourth, calculating state taxable income. And finally, dividing the tax pie.
Section 1. The multi-state tax maze, navigating over 7,500 tax jurisdictions.
The moment a business like Ken steps out of its home state, its commercial domicile, it triggers a whole cascade of potential tax liabilities. But how does a state actually lock you into its tax system? It all comes down to one absolutely crucial word: nexus. If you remember only one word from this entire explainer, make it nexus. Nexus is the minimum connection between a business and a state that allows that state to legally tax the business. A business will always have nexus in its home state, of course, but when it operates across borders, it has to look at its activities and ask, do I have nexus here? If yes, taxes are due. If no, you're in the clear.
Section 2. Sales and use taxes. Who collects and who pays?
All right, let's break down the mechanics of the taxes on your everyday purchases. Whenever there's a taxable sale of goods, the first question is always this: does the seller have sales tax nexus in the state where the goods end up? If yes, boom, the seller collects the sales tax from the buyer and sends it to the state. Simple enough. But if the seller does not have nexus, they don't collect a dime. Instead, a use tax accrues directly to the buyer.
Let's contrast those two concepts, because honestly, it's a massive point of confusion. Sales tax is the burden of the seller to collect and remit. Use tax is the exact same tax rate, but it's the burden of the buyer. So think back to Ken's River Runners. If someone in Colorado buys a raft from Ken's Wyoming website and Ken has no nexus in Colorado, Ken doesn't charge them tax. But that customer, they actually legally owe Colorado use tax on that raft, and they're supposed to report it on their personal state income tax return. Wild, right? Now, for decades, nexus meant you needed a physical presence, like a literal storefront or an employee in the state. But that entire concept got turned upside down in 2018 with a massive Supreme Court case involving the online retailer Wayfair. The court decided that physical presence was totally outdated in the digital age. They created economic nexus. Now, even if you have zero physical footprint in a state, if you make more than $100,000 in sales or you process 200 or more individual transactions in that state, you've got sales tax nexus.
It's super fascinating to see how global corporate giants handled this earthquake in tax law. Listen to this quote from Wayfair's 2022 annual report. They note that despite creating this monumental shift in taxation, the actual financial assessments weren't material to their overall business. For them, it just became a cost of compliance. But for a smaller operation like Ken Brody's rafting company, hitting that 200 transaction threshold in a neighboring state means a whole new world of administrative burden. The rules apply equally to everyone.
Section 3. Income tax nexus. Physical presence, economic presence, and protections.
So we've covered sales tax on individual transactions, but what about taxing the overall corporate profits of a business? That is income tax. Income tax nexus can also be triggered by physical or economic presence, sure, but there is a massive federal loophole that businesses absolutely love,
called Public Law 86-272. This law protects you from paying state income tax even if you have nexus, but the rules are super strict. You must be selling only tangible goods, no services. Your activities in the state must be strictly limited to the solicitation of sales, and all orders must be approved and shipped from outside the state. So if Ken sends an employee to Oregon just to hand out brochures and ask for orders of physical life jackets, he is protected, no Oregon income tax. But if that same employee brings a life jacket to sell directly or offers to repair a damaged raft, that protection vanishes instantly.
But what happens if Ken splits his business, say a retail company and a services company? How on earth does he file? Well, some states want separate tax returns, where each legal entity files its own paperwork. But a lot of states have shifted to unitary tax returns. Under unitary system, if Ken's two businesses share functional integration, centralized management, or economies of scale, like using the same marketing firm or sharing a bank account, the state views them as one giant unitary group. They force Ken to combine the income of both businesses onto a single return. It's basically their way of preventing companies from shifting profits around to dodge taxes.
Section 4. Calculating state taxable income. Adjusting the federal tax base.
Okay, so Ken knows where he has to file, but how does he actually do the math? The good news is states don't totally reinvent the wheel here. Almost all of them use the business's federal taxable income as the starting point, but federal law and state law don't match up perfectly. So businesses have to make very specific state tax adjustments to get to their actual state tax base.
What do those adjustments look like? Well, you've got positive adjustments that bump up your state income and negative ones that lower it. For example, on your federal return, you can deduct the state income taxes you paid. But the state? They are definitely not going to let you deduct their own state taxes to lower your bill. So that becomes a positive adjustment. You have to add it back in. On the flip side, states are constitutionally banned from taxing federal interest, like income from U.S. Treasury bonds. If you included that in your federal income, you get to make a negative adjustment and subtract it out for the state.
Section 5. Dividing the tax pie. Apportionment and allocation.
Once Ken makes his adjustments, he has his total taxable income. But wait, he does business in multiple states. How do we make sure he isn't being double taxed on the exact same dollar? We have to slice up the tax pie. And slicing it requires sorting income into two buckets: apportionment and allocation. Business income, the money Ken makes from actively running his rafting company and retail stores, goes through apportionment. It gets divided up fairly across all the states where he has nexus, based on a mathematical formula. Non-business income, like if Ken's company earns dividends from a passive stock investment, goes through allocation. Allocation means assigning that specific income directly to one single state, which is almost always the state where the business is headquartered.
When states calculate their specific slice of that business income pie, they used to rely on a three-factor formula. They'd look at what percentage of Ken's total sales, total payroll, and total property were located inside their borders, average those three numbers, and take that percentage of his income. But today, most states have shifted to a single weighted sales factor. They literally only look at the percentage of Ken's sales in their state. Why? Because this heavily favors local, in-state businesses that have a lot of property and payroll locally, while shifting the tax burden onto out-of-state businesses whose only connection is selling products to local residents.
Which brings us right to the bleeding edge of the tax maze. As we've seen with the Wayfair decision and the shift to single sales factors, states are constantly adapting to capture revenue. Now think about this. The IRS treats cryptocurrency as property, meaning nearly every transaction can trigger a capital gain or loss. If an internet business has economic nexus across 30 states and is accepting crypto, how does that income get apportioned? Is it business or non-business income? The rules for our digital age are literally being written right now, and the tax maze is only getting more complex. Thank you for joining me for this explainer, and I highly encourage you to keep questioning how the mechanics of our digital economy are being taxed.